Good afternoon, everyone, and welcome to our webinar, 2017 Proxy Season Preview. Today's event is presented by Compro.biz, powered by Onstream Media, and is being sponsored by KPMG. Please be advised that today's discussion is being recorded, and it will be available on demand later this afternoon. We have a number of media representatives attending today's webinar. Pursuant to Chatham House rules, while the media is free to use information from the discussion, we would ask that media representatives seek permission from any panelists they want to attribute a quote to. We are hoping to make this discussion as lively as interactive as possible and welcome your questions throughout the discussion. You can either send us questions using the Ask a Question feature in the webinar platform or via Twitter using the hashtag Proxy Season 2017. At this point, I would like to introduce our moderator for today's discussion, Stephen L. Brown, Senior Advisor at the KPMG Board Leadership Center. Stephen, the floor is yours.
Thank you very much. I appreciate it, and I appreciate everyone who is on the line for this session. And what we're going to do for the next hour, and we will end by 3 o'clock, is with this esteemed group of panelists is go through issues which we think we will see this proxy season and give a little bit of guidance where we can, and then talk about what to watch for and what we should be looking for this proxy season and beyond. Our panelists include a variety of viewpoints, the investor viewpoint, and those of advisors to management and the boards. I think you'll find our panelists 3 distinguishing features about this group. One is that they have a tremendous amount of experience, each of them, with proxy seasons and governance issue, nearly 100 years of combined experience in governance, and each is a prominent speaker on the issues. They are different viewpoints. The second point from the investor experience and advisors to board. And third, which I just realized, is that none of our 3 panelists, including your moderator, has an alma mater that's in the fight today with the NCAA tournament, the men's tournament. I will note that the women's tournament includes the University of Pennsylvania, where Amy went, and they are there, but we're not represented in the men's tournament. And let me start by introducing Deputy Director of the Council of Institutional Investors, Amy Boris, where she manages the proxy voter group at CII and the Forum for Senior Governance Professionals. As you know, CII is a nonpartisan, nonprofit association of institutional investors and representing over $23 trillion of assets under management when you combine all of their members and associate members. So thank you, Amy, for joining us. Mark Harnett. Well, glad you're here. And Mark Harnett, is Managing Director of Strategic Governance Advisors. And he is a managing director there in the New York office. And Mark brings us well over 30 years of experience in the proxy business and has provided counsel to hundreds of proxy contests, tender offers, and mergers. He has specific expertise as the lead strategist on timing and the content of proxy campaigns, consulting and briefing corporate boards and CEOs, and messaging for proxy campaigns. Prior to joining Strategic Governance Advisors, Mark was president of McKinsey Partners, a proxy solicitation firm and investor relations and governance consulting firm, which he co-founded. Lastly is Keith Godfrey, a partner of Shareholder Activism, defense practice leader at Morgan, Lewis & Bockius. Keith and I go way back, having worked at the same firm many, many years ago. I feel old, Keith. Keith has done a spectacular job for Morgan Lewis, where he and his team, the activist defense practice team, has been highly ranked, 1, 2, or 3, depending on the year and depending on who's rating, in terms of activist defense. He speaks nationally on these issues and has helped plenty of companies with their anti-activism campaign. So with that, I greet my 3 panelists and would like to get into the discussion, which I said we'll first sort of set the scene of what we're looking at in the state of affairs for proxy season, then talk about some key proxy issues. We would be remiss if we didn't discuss hedge fund activism and tactical responses, and then end with talking about what we should be looking for in terms of votes this proxy season and things that we can do during proxy season and then right afterwards as we prepare for 2018. As everyone should know on this phone, that it's where we are today that proxy preparedness is a year-round issue, although we spend the next few months actually going through the annual meetings. It's really an all-year issue. So with that, I'm going to open this up to all of our panelists, is sort of talking about the state of affairs going into proxy season. What is that state of affair, particularly when we think about the last few years of shareholder empowerment, even as we've entered with a new administration in D.C., which has, in an environment of deregulation, you still have this issue of shareholder empowerment. So I wanted to open it up to our panelists. What do we think about that? We've seen a number of governance letters, whether it's the common sense approach to corporate governance, or the larger investors, BlackRock, Vanguard, State Street, have come out with their own letters. We have an investor stewardship code in the U.S. for the first time, which has been announced earlier this year. We have governance shops who have bulked up in building their teams. And I just wanted to open up to talk about the state of affairs. Please.
Stephen, I'll start. It's a bit of the best of times, the worst of times, to quote loosely from the opening sentence of Charles Dickens' A Tale of Two Cities, but then again, I was an English major. Shareholders today have more tools, have more tools today than they had 10 years ago. When you think about majority voting, how ubiquitous it is in the S&P 500, proxy access, declassified boards, required say-on-pay votes, the fact that, as you referenced, traditional asset managers are engaged in putting ever more resources into ESG issues, and that many companies are actually eager and some boards willing to engage with their shareholders. And, of course, hedge fund activists have growing clout. At the same time, shareholder rights are under threat. The Business Roundtable is pushing I'm using air quotes, reform plan for the shareholder proposal rule that would sharply restrict shareholder proposals. The Financial Choice Act that on the House side of the Congress last year and a new version to come this year would eliminate the Dodd-Frank requirement to have regular say-on-pay votes, among other things. And, of course, there's growing popularity, especially with high-tech companies that are IPOing, of dual-class and even no-vote classes of shares. The latest iteration, of course, being Snap Inc.'s bottom-of-the-barrel decision to make its debut on public markets with no-vote shares. And this can only encourage other markets like the Singapore Exchange and the Hong Kong Exchange that have, some interest, have held the line so far on listing standards for dual-class companies to rethink that. So it's a mix of times.
Thank you. Mark or Keith, do you want to add of what you're seeing or what we should expect going into proxy season?
It's Mark. I'll go next, which is that I think what you're the greater empowerment comes hand in hand with the institutions relying less on the proxy advisors. They are using now the proxy advisors more as a data source and a resource as opposed to for their voting recommendations. The voting recommendations to some institutions are still important, but the various institutional shareholders, both on the index side and the actively managed side, and their governance departments have now their own set of guidelines which dictate how each of them individually will approach an issue. And I think that less of a reliance on the proxy advisors and more, taking that decision-making in-house is really where you're seeing the empowerment. BlackRock now has more analysts in the governance department than ISS has. And, Vanguard and State Street are extremely engaged in the analysis and decision on both contests and M&A, as well as routine shareholder votes. And companies are now learning that they need to engage directly, not only during the proxy season, but outside of the proxy season, with the governance departments at their major institutions, both indexed as well as actively managed, because that is where the nexus of power now resides. Keith?
Yeah, Stephen, I think one of the interesting things, the many interesting things that we're seeing when we think about shareholder empowerment and the effect that hedge fund activism has had is that now when we look at funds that we historically had thought of as being passive, that now the number of folks who are passive, maybe they're not running proxy contests, but they're far from passive. And so we're seeing much more aggressiveness on the part of the passively managed funds who want to be active, and not just making 1488 proposals and things of that nature, but really wanting to have an influence on board composition and policies of the company. And you look at the recent announcement by State Street on how they're going to be starting to hold companies accountable for diversity on the board. It's just, I think, the latest example of where we're seeing these historically passive institutions start saying we're going to want a larger voice. Maybe we're not becoming 13D filers anytime soon, but we want to have a larger voice in board composition and in the strategic direction of the company. And I think we're going to see more of that.
I agree. When I started in this business, for an investor to vote against a director was seen as the ultimate nuclear option. And I think today where we are is that it's just another vote. They are emboldened and empowered to do so, and you see these statements being made that really is putting folks on warning that they are prepared to do it, whereas 10 years ago it would have been a great hesitation. It's often thought, if I could just move on for a second, that well, it is the fact that large caps have been the focus of shareholder proposals and activism for decades. The question is, and they have responded and have changed their governance for the most part in response to that activism. But what about mid caps and small caps? What's the prospects or outlook for them going forward from this proxy season on for small caps and mid caps to be targeted?
Stephen, this is Amy. I think that large caps will continue to receive the bulk of shareholder proposals because proponents tend to focus on their most significant holdings by asset size, and because there is headline value in that. But there's no question that mid and small caps are increasingly on the receiving end of, letters asking for engagement or, for example, proxy access proposals, and certainly for other issues such as majority voting, where almost 90% of the S&P 500 have adopted or embraced majority voting in some form. Now, there have been letter campaigns every year by California state teachers and California public employees and now CII asking those companies, the many companies in the Russell 3000 X 500 that have not adopted majority voting to get with it. So I think on certain issues they're going to be drawn. The mid and small caps are going to be drawn in. The attention is going to be turned. And the reason we started sending letters to all those companies that didn't have majority voting, we figured they weren't going to change unless somebody asked them. They're usually out of the spotlight. So I think increasingly they will be in the spotlight.
Amy, I would add this, Mark Harnett, and to the audience, I would, though, add that we spend quite a bit of time with management and boards of the sort of mid-cap and small-cap companies. And more, either through the director's own initiative or because they've tasked advisors with bringing them and educating them on where best practices are in corporate governance. The companies are in that sort of mid-cap, small-cap space are taking the steps to adopt both proxy access proposals as well as majority voting, and not waiting to get a shareholder proposal, whether that shareholder proposal would be coming in 1 or 2 or 5 years. They are advised for both benevolent reasons that they should be good stewards of corporate governance, as well as for reasons that include better to adopt it on terms that, while in the mainstream, lean towards being, let's just say, more company-friendly than maybe the proponents put out. And so that's what you see. I will say that there are a couple of proposals, particularly companies that in the mid and small cap space still have staggered boards, that they do sort of sit back and wait for a shareholder proposal to come in before taking down that defense, and will wait that one out. I think the feeling is that by adopting proxy access, by adopting majority voting, for lack of a better term, you're not giving away all that much. It's unlikely to be used in all but the most extreme circumstances. But if you were to take away your staggered board, the perception is you've become vulnerable to a takeout, and once you take it down, you're never going to be able to reinstate it. You'll never get the shareholders to approve it. So I think you do see, and it's gradual, but the pace is picking up, greater adoption sort of in that realm, and that's probably a good sign that the war was won on proxy access, and the fight and the battle wasn't very long. And once the large cap companies and mega cap companies started adopting it, many of the other companies started falling into place. And there's cross-pollination of directors. Not good directors don't just serve on large cap companies. They serve on startups or smaller cap companies or spin-offs, et cetera. So they bring with them an institutional knowledge of what best governance practices are, and inform their other board members on these smaller cap companies to consider it and adopt it and not resist it.
Keith Gottfried, Mark, I'll just point out that on the majority voting, when you look at the smaller companies like in the Russell, if you look at the Russell 3000, or I'm sorry, you go to the Russell 1000, and where is it? On the Russell 2000, only 28% of companies have majority voting, and so there still is a lot of those companies out there in the small and the micro cap space that have yet to adopt majority voting, and probably are not going to do it proactively if they're not getting a letter from, let's say, CalSTRS, or not defending against a proxy contest where they think that there is some pressure on them to put themselves in a better corporate governance profile. And I think the other challenge here is for the small caps and the micro caps, given that over the past year, it's over 75% of activist campaigns are at companies with market caps less than $1 billion. It's much easier for a large cap to be proactive about corporate governance because most of the large caps are just not going to be targets in the regular ordinary course, whereas the small caps are going to be targets. And when they start taking away their classified board and majority voting, which leaves them vulnerable to a vote no campaign, an increasing number of vote no campaigns in 2016, I think those things present challenges for those small cap companies in terms of making them vulnerable to the hedge fund activists.
Agreed, and I think before we move on to talk about some of the proxy issues that we're going to see, I think it's fair to say that this environment makes it extremely important for customized advice, so that the full employment for those on the phone listening in and those on the panel to have some really nuanced advice about how to deal with the the environment that we're dealing with. Mark, you had mentioned proxy access, so let's go with talking about some of the core governance issues, starting with shareholder rights and structural governance. Proxy access, we saw proposals the last couple of years that has moved. The concept of private ordering has moved like wildfire. Where are we today? Maybe we'll start with Amy with proxy access.
You're right. It has been like wildfire, kind of really amazing speed up. When you just think back to 2014, only about 1% of the S&P 500 companies in the S&P 500 had embraced proxy access. Today, according to ISS, it's about 57.5%, and probably going to shoot up 65 or 70% of large caps by the end of the year. The New York City Comptroller's Office has been spearheading this, and again this year has filed about 70 proposals, proxy access proposals, but all but 20, I think, will be withdrawn before a vote because they're just enmeshing. They're having one engagement after another that have resulted in companies agreeing to adopt a consensus approach to proxy access. It's the so-called 3-3-20 or 25 for board seats, and they're also focusing increasingly, as you mentioned before, on the smaller companies, with the idea that proxy access should be there should be a uniform standard for proxy access. But so far, very few, I think less than 5% of the smaller, the Russell 3000 has adopted access. Some individual investors are pursuing so-called fix-it proxy access proposals. These are shareholder proposals aimed to amend existing proxy access bylaws, mainly asking companies to increase the aggregation cap, the cap on how many shareholders can form a group to nominate a candidate. The consensus figure has been about 20, and they're pushing for 40 or 50. I think most of these, from what I can see, are getting knocked out by the no-action process, as companies argue successfully that they should be able to exclude these as substantially implemented. But it's going to be another banner year, I think, for proxy access.
How about? Sure, go ahead, Mark.
Well, I was going to say that it's Mark again. That there were, I think, two forces at work here. One was that I think 3 years ago, the concept of proxy access was quite worrisome to a lot of boards. They felt that within minutes of adopting it, they were going to be faced with the possibility that a activist could move into the stock and instead of having to wage a proxy fight on the activist time, be able to piggyback in the company's own proxy statement and get board representation. I think it's taken a couple of years to sort of, as people get a better understanding of how proxy access is more likely to be utilized, for companies and their boards to understand that it's not likely to be used by most of the activists, the household name activists, as well as some of the activists that play in the and invest in the smaller spaces. That both because of the requirement of holding for long periods of time, and some of the limitations which would come along with putting your nominees on the company's ballot as opposed to running your own proxy statement, including access to the shareholder lists and to the voting returns, et cetera. That what we're anticipating is that there really aren't going to be many activists using proxy access, and they're still going to wage their contest or threaten to wage their contest the old-fashioned way through using their own proxy materials, et cetera. Secondly, there's at least been one instance of the potential for proxy access being used this proxy season, and the company pushed back on the particular proponent's ability to use proxy access, that the company's definition of proxy access and the people who could use it not only included the holding period and the holding amount, but also that they could not be, in essence, full-time activists, that they had to be long-term non-activist shareholders. And in that case, there was not a lot of pushback, and that particular shareholder stood down. So again, I think the boards have come to worry less about adopting it and have sort of viewed that they can get a lot of credit as good corporate stewards if they go ahead and adopt it. Keith, would you have any take on it?
Yeah. One of the Mark, I think is going to be interesting is to see to what extent the folks that fought for proxy access, like the New York City controller, to what extent that once that tool becomes much more widely available, and they've gotten their arms around it and maybe have gotten staffed up, is whether or not they use it by themselves or whether or not they team up with an activist or in parallel with an activist. We've seen you and I have been involved in some other situations where an activist and a institution has teamed up, and whether or not that's going to happen in proxy access is going to be interesting. And there was a recent conference where one of the institutions had said that was something that was a possibility, that they might. It was unclear whether or not they would be going by themselves or would be teaming up with other folks.
And this is Steve. And indeed, one of the things and I'm jumping ahead, I apologize. One of the things to look out for this proxy season is the response to proxy access, coupled with, and we'll get to this in a little bit, the proposals and discussion around diversity and climate change. And I say that only because one of the reasons 2 years ago that New York City went forward with their proxy access campaign to get adoption is because they were choosing targets that were weak in those issues, climate, environmental, and diversity. So it would follow that as we're seeing more of an awareness and a consciousness and a willingness by other investors to engage and indeed vote on these issues, that what's going to come to fruition is what the comptroller of New York City actually set out to do a couple of years ago with his targets of proxy access. If I could just move on very quickly to the issue of majority voting. We had talked about it, that many of the large caps already adopted it, but the three Cs, CII, CalPERS, and CalSTRS, I know have been on a campaign for quite some time to do sort of a cleanup of going to companies, particularly those large caps that had yet to adopt that, and putting proposals there. Is that going to be the same this year, Amy?
Yes, CalPERS and CalSTRS have already sent letters to 50 to 100 companies each, and are engaging with them. And as I mentioned, CII last year, we decided to send letters to all of the companies in the Russell 3000 that had not yet adopted proxy access, because we felt, as I think someone referred to earlier, they just needed to be asked. And we're finding we're getting responses back. We've been doing this in tranches, so I can't give any numbers, but anecdotally, we're getting a fairly good reception at companies we've heard from. But I think this will be an ongoing. There's so many companies, smaller companies, that don't have majority voting. I think this is going to play out over a couple of years, and certainly through this year.
Another thing that's been on the books for quite some time, 6 years, is Say on Pay. And I almost forgot in the earlier conversation that this is the re-up year. And so, as everyone knows, Say on Pay has been around for 6 years now, and this is the year where we'll have another frequency votes at companies that have put in Say on Pay. Any thoughts around what we're going to see with these frequency votes? Will corporations be changing who had annual votes to triannual or biannual?
Well, it's Mark. I just don't see any company getting approval for anything other than annual, and I would even recommend that no company try to. There'd be somewhat the law of unintended consequences. Just because you wouldn't have an annual Say on Pay vote doesn't mean that your shareholders can't express how they feel about the executive compensation, and that you won't have to engage with your shareholders to pitch your board's compensation philosophy and structure. And if there's not a say-on-pay vote that they can vote on and reflect how they feel, and et cetera, then they're going to target members of the comp committee or the entire board with withhold votes and negative votes. So to me, a company would be better served, and I think, I haven't done a full poll, and I don't know if it's out there, but the clients that we've seen and the proxies that we've seen pass are mostly going back to, are staying with the 1-year approval. I don't know if Amy or Keith, you've got a different experience or different viewpoint on that.
I think that's about right. We surveyed our members informally, and although there are a few investors who prefer triennial or even every other year biannual, the vast majority like having annual votes. I know there's an investor group, a coalition of investors that has been writing to, I think there's 318 companies in the Russell 3000 that have triennial votes, and they're asking them to switch. As of last week, I was told that 14 of those companies had agreed to switch and 70 are considering it. So I agree with you. If anything, it's that we're going to see more of an embrace of annual. And if, I think a lot of companies are finding, as you referenced it, the stand-pay has been a real catalyst for engagement with shareholders. You learn things, they learn things. And it's leading, that willingness to engage on pay is rippling over into other issues. So there's benefits beyond just the say-on-pay vote.
Absolutely. And we'll get back later talking about dual-class shares and no-class shares a little bit in a moment. But moving on to sort of board composition and the board suite and those issues, what are we going to see this year? Tenure and board refreshment for the last couple of years has been a hot subject. Tenure, board composition, board refreshment, and diversity. I should sort of put them all in one in terms of director quality has been big issues for the last couple of years. But this year we have some announcements, from large investors about their willingness and their desire to drill down on those issues.
Well, I can take that one, sure. Stephen. Yes, I think you mentioned that earlier that State Street Global Advisors put out in its advisory to shareholders what it's going to be engaging on and holding its portfolio companies to really push them, those that don't have representation of women on boards, to really move in that direction, or perhaps down the road face votes against directors. So that should light a fire. I think there's we'll see some shareholder proposals, or maybe lots have been filed, but more and more this is an engagement issue. And it's for that whole suite of board compensation issues, whether it's refreshment or tenure or diversity. And, I think that our members feel that the research claims often are difficult to evaluate, but the research on these points appears strong, that diversity is beneficial for boards, and yet U.S. companies have been moving rather slowly. They're making, it's getting better, but progress of women on boards is inching up. But actually, if you look beyond that, if you look at the progress of directors of color, that's stagnated. There's some statistics. I think Spencer Stewart puts out statistics on the S&P 500 and percentage of African American directors, and directors of other ethnic or racial backgrounds has just not moved in the past 5 years or 10 years. So that needs attention too. But right now there's a lot of attention, particularly on women on boards. And there's a Midwest Diversity Coalition. That is a group of public and labor funds that's engaged 17 companies throughout the Midwest, asking them to adopt the so-called Rooney Rule, that the board's candidate pool for new director slots must include at least one woman and one minority. And, companies are starting to adopt that language. So the focus on diversity is taking, there are different groups pushing this in different ways.
Mm-hmm. Indeed.
I want to ask Amy a question, since from her role at CII is, and the fact you guys interact with the proxy advisory firms quite a bit, and And why is it that the proxy advisory firms are not pushing diversity more? I mean, if they were to make it an issue that puts you really at risk of a withhold recommendation, like so many other things, public companies would be moving very quickly to take care of that issue, and yet they're not. And as you noted, I mean, the diversity it's shameful. I mean, it's shameful that when you look at Fortune 1000 companies, less than 18% of the boards are women, and the statistics on people of color is also shameful. So why is it that the proxy advisory firms have not gotten their arms around that more aggressively?
And not to gang up on Amy, but we might as well. So I tend to look at things and keep those two through the prism of shareholder activism, and it has been the case that companies that when a company is faced with an activist, the diversity on the company's board is a virtual non-consideration on the part of proxy advisors and shareholders, and the makeup of the board. The board members just become pawns in a chess game, and there's companies that have spent quite a bit of time assembling a highly qualified board with a diverse set of viewpoints are shocked and surprised and depressed when they find out, either because this is how we advise them, or they actually hear it for themselves, that it becomes unimportant in a proxy contest. Strangely enough, and I've over the years, not now, but over the years, have worked for activists. The activists are frankly much more self-policing in terms of which directors they may go after in a proxy contest, in terms of not necessarily targeting the directors who are on the boards that create the diversity. But the shareholders and the proxy advisors really lag on this in proxy contests and really don't take it into account and don't give the companies credit for it.
Well, that's a really good point, because I can't remember where I saw it, but I did see a list of recent directors who have been put on boards through activist campaigns, and they are uniformly, and not entirely, but white males. So the activists themselves are not putting forth diverse candidates or diverse nominees for boards, from what I can see. But you need to ask the proxy advisory firms why that question, why they don't push this more. I think what we're starting to see is, with the large asset managers stepping in and making this an issue, following on the heels of some smaller institutional investors and public funds and others that have focused, that there is kind of a groundswell. I think you can't. When the big indexers make this an issue, companies can't look away. And it's starting to ripple into different, the diversity question is, there's now, we're seeing proposals on pay equity, gender diversity, efforts to close the gender pay gap, which is not a board question, but, again, New York City has focused this proposal at insurance and healthcare companies, asking the company to identify whether there's a pay gap among the company's employees, and if so, what policies or what measures are you taking to mitigate that or to close the gap. So the diversity question is morphing in or moving down the line into a workforce issue as well.
Excellent points, and I think we've all been around these issues for quite some time in the proposal land, and I think the speed to which they're being accepted by the larger investors is lightning, to be honest, and it stems partially from the activists who have pushed this for years have been frustrated with the way large investors have voted or not voted for it. Actually, it's not voting for it, and so they've sort of been put on the carpet with proposals to their parent corporations, basically looking for a review of how they voted. And as we all know, the infrastructure has been in place for quite some time with Form NPX that details those votes. And I think that's the takeaway from this proxy season and those in proxy seasons going forward, which is investors are going to be scrutinized by the way they voted, whether it's the press or other investors, and that has put some heat under this. If we, the issue of diversity and the issue of climate change are sort of big things to watch in the environmental and social space of proposals, and we know traditionally that those proposals, have done okay, but not many of them have won. But doing okay it has been good enough for many folks looking at the 20% range. However, we saw a couple of those win, and many of them almost win, which is why I think you see the big push this year to get the large investors on board. I just wanted to mention and sort of put out there the different types of proposals, and I think Amy hit it on the nose. Folks who've been drafting these have been drafting them for a while, a long while. They're getting a lot better at it. They're getting better at making their case, and they're getting more nuanced. We'll see this year, as we saw last year, what they call the 2DS, 2 degrees scenario, 2 degrees Celsius scenario. And, of course, this is coming out of the UN-sanctioned Paris Agreement of limiting temperature change to within 2 degrees Celsius, and asking those companies who get these proposals to respond to that and talk about their plans and the risk involved given that agreement. And we saw many relatively successful proposals last year, and then we're going to see more of them. Sure, Amy.
Yes, I do think you'll see more of them. Last season, these so-called stress tests or 2-degree proposals averaged a little over 37% support, and that's pretty high for a first-round shareholder proposal. It almost passed at Occidental, and I think we're going to see, support grow this year. A lot of these proposals will probably come to a vote. You have to keep in mind, I think, with the Trump administration's turning away from support for international agreements, and I think investors are going to be doubling down on private ordering, if you will, and more focused on making sure there's strong support. We may see fewer but more concentrated efforts at companies to get more of those proposals over the 50% finish line, if you will, get more of them passed. I think there'll be a lot of attention on climate change proposals, and particularly the one you mentioned.
Absolutely. And now I want to move into, because I said in the beginning we'd be remiss if we didn't talk about hedge fund activism and have Keith and Mark talk about what the outlook is. But before we get there, let me just bridge the gap between diversity and hedge fund activism. I had a conversation a couple weeks ago with a hedge fund activist, someone who's been very successful at it, not a newcomer, who talked about the issue of diversity on boards. Had a very deep conversation. They've been looking at this for quite some time, and they are convinced about the evidence of diverse board members, and are thinking heavily how that factors into the slates that they put up. So I thought that was an interesting development to have that conversation. So Keith and Mark, if I can just ask very quickly, if we can, what does the outlook look for hedge fund activism this year? And is there a different playbook that the activists will have in 2017?
Keith, you want to go?
Sure. So, if we look back at 2016 as a trend, a continuing trend, I think you're going to still see north of 100 proxy fights this year. I think it's going to be a very busy year. It's already shaping to be a very busy year as we start getting closer into the height of proxy season. We're almost there, but not quite. But lots of notices of nomination have been coming in on a regular basis. So I think this is going to be a continuing big year for hedge fund activism. I think the dominant theme is still going to be looking for board representation, as it was in 2016. Interesting will be whether or not when we finish out the 2017 season, there'll be that continuing trend we saw in 2016, which was a significant number of first-time activists. Where that group made up, was I think over 50%. First-time activists, according to Shark Repellent, represented approximately 50% of the activists representing conducting campaigns last year, which also maybe not coincidentally maybe had an effect on the fact that we saw an uptick in the number of situations where the companies or management was successful. So I think you'll see a continuing trend of that. And just finally would be that given where the stock market is today, I won't use the term frothy, but the fact that the stock market is substantially up, at least on the major indexes, I think that's probably going to mean that we'll continue to see small caps being the dominant place. Probably close to 80% of the campaigns will be at small caps, because maybe some of the large caps are too expensive. Not only are they too expensive for some of the activists to go after, and some of the larger activists have had some challenges, but also I think the large caps now have lots of currency to go after the small caps, and so that's even going to encourage more small cap activism, the fact that the large caps are expensive and may be looking to use some of their currency.
I would say that so adding on to what Pete said, which is what we're observing as well, two trends two things to keep in mind. One is that the activists continue each year to recruit better and better candidates to serve on the dissonant slates. It is no longer just folks that work at the hedge fund or friends or family. They are able to recruit quality people in the industry. The irony is that sometimes the folks they recruit are on companies which they gained representation in earlier proxy contests, and some of their candidates in contests we're seeing in 17 were folks that they were opposing a couple of years ago. But you get CEOs now from large cap companies that are serving on activist boards, that are retired CEOs and retired CFOs and people with a lot of public board experience serving on these dissonant slates. The second thing, and I don't know where it's going to shake out, and it may be a continuum of where we were in the past, but there's been a changing of the guard in terms of the leadership at ISS on the proxy fight side, and the folks that in the last 6 years, the group was led by Chris Cernich. Chris recently stepped down and is now a partner of mine, and the folks that he have trained and have continued on, and it will be to see if there's a shifting from a point of view on and how often ISS will be supporting activists over companies in the future. Again, statistics are tough to come by because they're somewhat weighted and don't account for settlements, et cetera, and not all proxy fights are being run by top-tier activists and the like. But, one of the significant players, one of the significant factors in a proxy contest, and I was the one about 40 minutes ago to say that folks aren't following ISS as much, and I still would stand by that, but the fact is that they're still advising a pretty big slug of the shareholder base in most companies, along with Glass Lewis, that the head analyst there there is a new head analyst, and we'll have to see if there's still the same sort of recommendations that seem to, at least on the surface, favor activists over companies.
Well, thanks, guys. And what I'd like to do in our remaining minutes is two things. One is tell folks, if you have questions, please use the question tab and ask. those. Two is just say we will wrap up with talking about some tactical issues and what to look for going forward. And three is actually answer one of the questions that did come in, and I'll put it to Amy first, and then others can respond. Do you see much interest in proposals on campaign political contributions?
Yes, I think that's become kind of a steady feature of the proxy season, and it's just that it's expanded. They started out with just pure disclosure of political contributions. Now there's growing interest in proposals that focus more broadly on lobbying and at the federal level, and now we're seeing more attention being paid to lobbying at the state level where disclosure is minimal. So I think this is there's been a consistent theme that this has been a focus. It will remain a focus for some time. And the interesting thing to me is that at least on the policies proposals that ask companies for disclosure of political contributions, very rarely do these proposals get majority support. But it seems like they just need to get to a critical mass, which could be somewhere around 30%, give or take. More and more companies are seeing that as a sign, well, maybe we should do something. And I think the numbers of companies that are adopting policies on disclosure and board oversight of political giving from the company's treasury, those companies, there's a growing number of companies that are doing that quietly. So there's a lot of engagement. This ends up being an engagement issue. But I think we'll see a lot of those proposals again this year.
Thank you, Amy. Do we any advice for folks going forward? Now, if I could break this up into two parts. One is, so we're about to start proxy season. There's not too much that you can do because we are in proxy season. But any thoughts about setting up engagement discussions? I've talked to people, and they still want to engage during proxy season. Of course, best practice is to at least have that conversation outside of proxy season and just follow up during proxy season. But is that a conversation, I'll put it to the panel, that's better had in person or over the phone?
Well, it's Mark. I think that while in person is better, the facts are that it's very hard for most of the institutional holders and having so many thousands of shares in their portfolio, and the desire on both companies' parts to engage now more than ever, as well as the investors recognizing that engagement is important. It's just not practical to be doing it in a face-to-face meeting, and the institutions are pretty much insisting that it be done telephonically and all, but in proxy contests, it's still mostly face-to-face, but in the normal, in today's engagement environment, it's being done by phone. I think the more critical question, Stephen, is who from the company should be on that engagement, and the answer is that the most effective engagement that a company can have with its largest shareholders should, in almost all cases, involve at least one, if not a couple, of independent board members. That's what this audience is used to. That's what they're expecting. That will send the right message, and it's the type of dialogue that benefits both the company and these investors. And to drive home that point, without naming names, if you can imagine the largest cap companies out there, they're when they are engaging in shareholder engagement, they are getting their members of the board to be part of that outreach. So if you're a good, well-functioning mid-cap, small-cap company and you want to involve in that same engagement and you don't have your directors on, it just sends the wrong signal, and it's not going to be the most productive call from both sides.
And I could tell you, Mark, before we go to other panelists, it's that audience, the mid-cap, small caps, who are still recalcitrant in having that done. And I think it's not to their benefit in preparing their directors, a director, to have that that conversation. That's where they've really been slow on the uptake there for that category of companies.
Hey, Stephen, it's Keith. We were talking about you were asking the question about what companies could be doing now and whether or not we're too far into the season that, well, there's nothing you could do for 2017. And I would suggest that there's a bunch of things that companies could do. In fact, I think two of the most important things they could do, they haven't yet done, which is, companies, all our clients are getting ready or in a process of putting pen to paper on the K. Some of them filed the 10K. You've got the proxy statement, and depending on whether or not they're 12/31 year ends, the retail folks have a late January. Those documents, as you think about those documents, companies should be thinking about them less as compliance documents and also as messaging. And what kind of messages information do we need to get to the investors about the company's strategy? Because there's lots of places to talk about the strategy in the K companies could be doing. And then in the proxy statement, are we being full and using enough plain English words to talk about our compensation philosophy and how we're compensating and paying for performance? And so those are places where those are opportunities that companies should be taking advantage of and not just thinking of them as compliance situations.
I would say amen to all of that. I think that you're absolutely right. More companies should view their written documents, particularly their proxy statement, as a communications document and use plain English. Have a non-lawyer read it before you hit the send button. Maybe break it. And this is really important. I think this is making your documents crystal clear and telling a coherent story is really important for the small and mid-cap companies that may not have the resources to do a lot of engagement or, with either in person or on the phone. Their documents may have to tell their story for them. So it's really important. If it's long, have an executive summary, break it up with headers that tell your investors what's new and different. What's new and different this year? Don't make them have to search for it. So I think presentation is very important.
Thank you. And if we can wrap up in the following manner, and I apologize, we're going to go over just by a minute or two. If perhaps we can get a sort of rapid-fire answer from our panels. One is, will we see more non-voting arrangements like SNAP to come this year and beyond?
Ooh, I'll be happy to talk about that.
Sure.
When a company goes to the capital markets to raise money from the public investors are entitled to certain protections and basic rights, and that includes the right to vote that's in proportion to the size of one's holdings. One share, one vote. It's a bedrock corporate governance shareholder rights issue. And what SNAP has done is, keeps tapping the public markets but giving public shareholders no say. We certainly hope other companies don't follow in its footsteps. And, to the extent we're so concerned about this, and so are some of our members, that we're engaging index providers to encourage them to say no to no-vote shares. This is a race to the bottom. I think we're likely to see, despite that, more. There have been companies coming to the market this week, making their IPO with dual class. The dual class phenomenon is unfortunately on the rise. It is not good for investors. Multi-class structures with unequal voting power deny shareholders a way to hold management and boards accountable. And I fear this is going to be a growing feature, but it's something that shareholders, and large and small, all kinds of institutional shareholders are just up in arms about this. So watch this space. I think you'll be hearing a lot more about this year.
Gentlemen, any comment?
It's going to be a give and take here because there's an incentive. I think it is good for the marketplace to have, more companies accessing capital markets. And if this is a way that it's done, going out with dual class or non-voting shares. Certain companies just would not access the capital markets if they couldn't do it that way. I think that they're, most of these companies have, informed directors, informed management. They'll hear from the marketplace. They'll hear from the corporate governance side. A lot of them are baking in that their sunset provisions, or they will be going to market with sunset provisions, et cetera. So I don't think it's just going to stay that way permanently. But I worry about the law of unintended consequences of pushing back extremely hard on this and et cetera. Listen, I'm in the business of dealing with shareholder voting, so it is an important right to me. But I just one size doesn't fit all in these circumstances, and we'll have to see how it plays out.
I think if more companies did adopt reasonable sunset provisions, that would be great. To take Snap as an example, I mean, the sunset provision is basically when both founders die. That's hardly practical. So I hope that you're right that more companies will really give thought to sensible sunset provisions.
Gotcha. And let us end with this, and it is a question that comes from our audience, and it refers to something we've been talking about all afternoon. Will the new voting, and maybe we'll just have a rapid-fire yes or no with a little bit of comment, will the new voting priorities recently outlined by BlackRock and State Street on climate change and board diversity really make much of a difference? Thoughts?
Yes.
Thank you, Amy.
Well, BlackRock and State Street are investors that boards and companies understand own significant blocks of stock and blocks of shares in their stock and exercise significant voting power. And just like politicians do not go out of their way to needlessly antagonize any particular constituency in their district, boards of directors do not go out, are cognizant and do not like to see large blocks of stock voting to withhold against directors or voting against even more important proposals that might be on the ballot. So I do think that you're going to see that what BlackRock and State Street have put out there, you're going to see that starting to be reflective in board makeup and company disclosures on climate change and other matters, and the diversity on boards. Yeah, I do think it's going to have a significant impact. And I don't think it's going to stop with just BlackRock and State Street. The members of Amy's organization have been very vocal on these points, and it's expanding to not only for their membership, but to other large cap, other significant investors. So. No, I definitely see this as being the trend, and it is moving the needle.
Keith?
Yeah, I echo everything that Mark just said. I think it's going to be a continuing trend that is only going to grow exponentially over time.
Excellent. And I certainly agree with I think that's 3 yeses, and a 4th for me, that it will have a significant impact. And one of the takeaways is after we're done with proxy season, is everyone should do a postmortem, not simply looking at their own votes, but looking at the entire body of proxy season, and that will be a great indicator of what to do in the proxy off season as we head into preparing for 2018. And with that, I'd like to thank our panelists for joining us, and thank everyone else on the phone for joining us this afternoon. We went over a few minutes there. I apologize, but we really appreciate you joining us today and sending in your questions. Thank you.
Thanks very much.
Thank you. This does conclude today's conference. We thank you for your participation. You may disconnect your lines at this time, and have a great day.